All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. Once again today, I'm digging deep into the Double Play archives going all the way back to September of 2020 to produce a video that I should have gotten out a long time ago. The information in it is a bit timely. So what I want to talk about today is when you should use a policy loan. And the thing is, since 2020, back then rates were at, historic lows. And 4 years later, rates have been going up considerably. So not everything, I shouldn't say everything in this video is not true. Just you need to look at it carefully and take your own circumstances into account. So where I would have used a cash value line of credit once before, I might use a policy loan now and go without the tax deductibility or just try to get away with the tax deductibility. So in any case, this video is when should you use a policy loan? Stick around after the intro and I will get started. And then also I will be introducing, I'll chime in with some footnotes throughout the video. I'm Tom Rutkowski with Innovative Retirement Strategies, and thank you for sticking around after the intro. Today we're going to be talking about when you should use a policy loan for investing in real estate. And the way I want to attack this today is I want to talk about the business model. What the results look like when you use a policy loan versus without, just so you can see the advantage of it. Second, I want to talk about the differences between a policy loan and a cash value line of credit so that you can see the advantage and disadvantage of each. And then lastly, I want to talk about the one example where it might make more sense to use a policy loan rather than a cash value line of credit. All right, so let's get started by looking at the business model. I just want to show what the numbers look like with and without tax deductible interest on your loan payments. So in the first example, I want to look at if you are using a policy loan to invest in real estate. So in this nice simple example, let's assume you're borrowing $100,000 against your policy's cash value. It's a true policy loan. The money's coming from the insurance company. And let's assume that you're loaning it to a real estate investor as a hard money loan at 10%. And let's just assume that the loan is being paid off in exactly 12 months. So at the end of 12 months on $100,000 at 10%, you've got $10,000 of income. Now, just to keep the math simple, we're going to assume a 40% tax rate. If the interest is not tax deductible, you don't have any deductions from your income. So you're going to pay taxes on the entire $10,000 of income that you have. So 40% taxes on $10,000 leaves you with $6,000 after you write a check to the IRS. Now, the loan interest still has to be paid to the bank. So if the loan interest rate was 5%, you write a check to the insurance company for $5,000, and that leaves you with a whopping $1,000. Now, that may not sound like much. You still have the dividends and interest crediting on the cash value that was securing that loan. But let's take a look at what it looks like if the interest is tax deductible. So, same example, same $10,000 of income at the end of the year, only this time when you write the $5,000 check to the bank to pay the interest, that's a business deduction. So when you're doing your taxes, you're expensing the $5,000. And after paying the interest and deducting it on the taxes, you've got taxable income of $5,000. Now in the same 40% tax bracket, that means you're going to write a check to the IRS for $2,000. $2,000 is 40% of 5. And that leaves you with $3,000 of income left over. So in this example, it's $1,000 if you were to use a non-tax deductible policy loan versus $3,000 if you use a tax deductible cash value line of credit. So that's a pretty significant difference. So now let's talk about the different ways we can access the cash value. So the normal way to access the cash value is via a policy loan. You would call up the insurance company asked to take a policy loan. They're going to verify that you have cash value in your account. They're going to ask you a few questions just to make sure that you understand what you're doing. And then they're going to send a check in the mail to you that you can use for whatever you want. There's no application. It's very easy to do. Your cash value is the collateral. The alternative to that is getting a cash value line of credit. With a cash value line of credit, you're actually getting a commercial loan or business loan from a bank. And the bank is going to want collateral for that loan. So you're going to give them an assignment of collateral against the life insurance policy. And from the bank's perspective, since their loan is 100% secured by the cash value of your life insurance policy, and it's very easy for them to foreclose if you were to default, they're going to give you a very attractive loan. Typically, these cash value lines of credit are at or near prime interest rate. So now that I've given you the business model with and without tax-deductible interest and shown you the advantage of being able to deduct the interest, and I've explained the difference between policy loans and a cash value line of credit, why would you want to use a policy loan rather than a cash value line of credit? Well, the reason is if you're buying a property and using lender financing for the majority of the purchase price, they're going to want you to come up with a down payment. And typically, when you're filling out the loan paperwork, you've got to disclose the source of funds. Now, the beauty of using a policy loan or cash value line of credit is that if you were to buy this house, you would have 100% other people's money in the deal. So any return you make is an infinite rate of return. So I hope you see the advantage of this. Now, you could use a cash value line of credit, except that you have to disclose the source of funds to the lender. And the lender may see that you're using a cash value line of credit, and they may want to see that you have some skin in the game. So you may find that your loan is denied because you don't have any skin in the game. But in talking with clients of mine, I do know that it can go either way. Some clients have said that they've gone and they've got a loan with a cash value line of credit, making the down payment. But other people have told me that the bank wouldn't accept that. But policy loans are an acceptable source of funds for the down payment, and you can disclose that without any issues. So even though you don't have the advantage of having tax deductible interest, by utilizing the policy loan in addition to the bank financing, you've still got 100% of other people's money in the deal. The policy loan, of course, comes from the insurance company. That's a loan secured by your cash value. And then the bank is providing the other funding to make the majority of the purchase. But either way, even though you're paying more in interest and you're not able to deduct it, it's still an infinite rate of return, and it's still attractive, and there's still a good reason for doing it. So one thing that you'd certainly find in all of my videos is that they're very practical. It's very much how to, why it works. And what I wanted to do with this video was show you, even though that you can't deduct the interest on a policy loan, there are still some applications where it makes sense to use a policy loan rather than what you should use most of the time, which is a cash value line of credit. So if you're hungry for more information, I highly recommend that you go out to Facebook and look for the Double Play group. I'll put a link to that in the description below. But the Double Play group is a mix of my clients, people who have life insurance policies from other agents and are already doing the Double Play, or they have life insurance policies and they're just interested in learning how the Double Play works, and just people who are interested in learning. But if you're interested in learning more and you're not ready to talk to an agent yet, that's a great forum to post your questions to people who are actually doing it without having the pressure of talking to a life insurance agent. Secondly, there's also a ton of other videos, so go down to the description and you can find links to all the other videos in my collection. And then lastly, my website is what I consider to be a no fluff zone. So you'll find typically a blog post or a web page that's dedicated to each one of the subjects that I cover in my videos and my bi-weekly webinars. So with that, I'd like to thank you for attending. Be sure to like and subscribe this video, and you'll see cards coming up for a couple of what I call recommended videos. So I encourage you to check those out, and I'll see you in the next video. Thanks.